Hello and welcome to Amagi, co-hosted by myself, Nima of economicsjunkie.com, and Dylan Moore of the Volitional Science Network, which you can find on YouTube. We are here to tackle ideas both ancient and modern in an effort to bring you the tools needed to expand the power of your worldview, making you a more potent entity professionally, politically, philosophically, or otherwise. We are graciously being hosted by the Think Liberty Network, which you can find at think-liberty.com. This is episode 33. We agree with Bernie and AOC. All right, Dylan has some articles that we need to go through to cover this topic. So take it away, Dylan.
Yeah, so apparently Bernie Sanders and Alexandria Ocasio-Cortez have teamed up, and their pictures are being taken together all over the place and splattered over the internet. And I've got to say, first and foremost, that having AOC stand next to Sanders has really reminded me of how ugly Bernie Sanders is.
Yeah.
I'm seeing all these pictures and I'm like, man, I really only want to look at half of this picture. Ugh. But they've seemed to have teamed together and they're working on a...
But at least he has integrity and a lot of profound thoughts.
Oh, yeah, that's right. That makes up for it. I forgot about that. But they're teaming together to make a Loan Shark Protection Act. So this is from this. I stumbled across this article from commondreams.org. Link will be in the description below. That entitled "To Tackle Greed of Wall Street, Loan Sharks, Ocasio-Cortez and Sanders' Plan Would Cap Outrageous Credit Card Rates." So let's take a quick look at this, because we've got some MMT things to say about this concept and the reaction, particularly from the libertarian side, to this news. So, Representative Alexandria Ocasio-Cortez and Senator Bernie Sanders unveiled legislation Thursday to, in quotes, take on Wall Street greed and protect consumers by imposing a 15% federal cap on credit card interest rates, which are a major source of financial industry profits. Ooh, we can't have the financial industry making any profit, Nima. We need legislation for this. The bicameral legislation, titled the Loan Shark Prevention Act, would allow states to establish interest rate caps lower than 15% and hit violators of that limit with steep penalties. Quote, "Today's loan sharks wear expensive suits and work on Wall Street, where they make hundreds of millions of dollars in total compensation by charging sky-high fees and usurious interest rates," Sanders and Ocasio-Cortez will say in a joint statement accompanying the plan. The Intercept's David Dayen reported ahead of the bill's release. According to Dayen, Ocasio-Cortez, quote, "plans to suggest postal banking as a public option for consumer lending, though that is not in the legislation," unquote. A postal lending option would, in theory, minimize the impact on access to credit from the rate cap, unquote, wrote Dayen. Sanders endorsed postal banking during his 2016 presidential campaign. In an email to supporters on Thursday, Sanders called for citizen co-sponsors of the Loan Shark Prevention Act. Millions of people now pay credit card interest rates as high as 30%. That's not banking, that's loan sharking, and it's time to stop it, said Sanders. The American people are sick and tired of being ripped off by the same financial institutions that bailed them out 10 years ago. They are sick and tired of being extorted by credit card companies. And then there's a little bit more. The rest of the article doesn't really say it all that much. It ends with, "I have a radical idea," said Sanders. "Maybe Congress should stand up for the ordinary people." Some political finger wagging there. So
nice finish.
Yes. So we've got this idea that the government should come in and cap interest rates charged by private financial institutions. So, seeing as this is on a libertarian network, I think it's worth pointing out the libertarian view on why this is such a horribly stupid socialist bullshit idea. Don't you think, Nima?
Let's hear him.
Okay, so this is actually from the Think Liberty Network. That was I don't think
Who's
they were.
That?
What's that?
Who's that?
The author?
Who's the Think Liberty Network?
Oh, the wonderful people who host us.
Oh, right.
That's right, yes. So this is from Daniel Siebel from the Think Liberty Network. I don't know if he was responding specifically to the article that I just read or just the fact that this news came out. He at least took the same front picture, link below, flipped it 180 degrees, and added a communist hammer and sickle to it. So, again, there's an ugly Bernie Sanders side and a pretty Ocasio-Cortez side to it. So, this one's entitled Economic Illiterate or Communist Mastermind. Bernie Sanders and Alexandria Ocasio-Cortez have proposed that credit card APR be capped at 15%. There is really no way that you can look at this proposal as a good thing. On its face, it looks like a good idea if you have no understanding of economics whatsoever. After all, who wouldn't want to pay a lower APR on their credit cards? However, there's a huge fault in that logic, which is the assumption that the credit card company would still offer you a card if they couldn't charge greater than a 15% APR. Here's the thing about credit card offers, which anyone who has either applied for or received a credit card should have some basic grasp of. Credit card companies offer you a line of credit at a specified APR based on an evaluation of risk. There are many factors that go into determining your APR, your credit history, credit rating, current liabilities, annual income, just to name a few, and all of these add up to an evaluation of how risky it is to give you a line of credit. There are other factors not related to the specific debtor being offered credit, such as demand for credit and the supply of funds to the bank. Put a yellow highlighter on that last part of that sentence. But for our purposes here, the most important factor is risk. So, Nima, did you want to take a pause here and comment so far, or want me to finish reading the thing off?
Well, yeah, I mean, since the supply of funds isn't really a major point for him, I think. He said the most important factor is risk, which is true because the banks never face any shortage of supply of funds because they can always borrow from the Fed if they want to at the Fed's rate. And so banks create loans out of nothing. They don't need to have funds supplied to them before being able to lend. That's just important to point out.
Yes. Thank you. Continuing, banks offer low lines of credit and high APR cards to debtors who are young, with little to no credit history, unstable income, and at the lower end of the income distribution. The low line of credit reduces the risk involved by reducing the total investment, and the high APR ensures that investors are more willing to take off on the risk for a bigger payoff. Sanders, AOC, and their followers may believe by capping APR at 15% that they are ensuring the young, lower-income people accumulate less debt, but in reality what they are doing is making it so that the risk is too high and the payoff too low for banks to want to make that investment. So, rather than lower-income households having access to low line of credit, high APR cards to use in emergencies, or to build their credit scores to a rating that might afford them better credit offers, they are cutting off entry so that only people who have established their wealth and reliability have access to credit.
Just to interrupt here, then he may not have read that they said a postal lending option would, in theory, minimize the impact on access to credit from the rate cap. That's just
worth pointing out.
Something, yeah.
Well, and then I'll also make this point worth pointing out that the way that the credit system works, and I'm not talking about like credit cards, I'm talking about like your actual credit report. And this is really more a comment on the public educational system because we don't have any idea how these things work. The credit system is really set up in a way that if you don't understand how it works and you do typical middle class or lower class stuff, your credit rating typically will suffer because you're hitting the wrong buttons on your credit report. Whereas if you understand how it works, there's some really easy tricks to make your credit report absolutely glow without really changing anything about your lifestyle. And it's the whole credit reporting thing. While it's important, there's a large part of it that's kind of silly, and it gets a little scammy. Again, not because it by itself is scammy, it's because nobody knows how to use it. And once you learn how to use it, this idea that, well, they offer these low limit, high APR cards to young people and people of lower income, you could skip all that. There's a way to like just completely skip over all that stuff, and if you find someone who knows their credit, they can tell you how. Going on. So many of Sanders and AOC's policy proposals would only drive a greater wedge between the lower quintile and upper quintile earners and limit mobility between quintiles. That I often wonder if they are really as economically illiterate as they appear to be, or if they're actually evil communist masterminds fully aware of the socioeconomic divisions these policies would create. Maybe they actually hope to make the lives for the poor so miserable that they see a violent communist revolution as the only option. Maybe. Ultimately, regardless of the economics of the policy, the morality of it can be broken down quite simply. Suppose you have $1,000 of disposable income and you become aware of a person who has fallen on hard times. You don't know how reliable the person is, whether or not you'll ever get your money back, or if there might be some reason you need $1,000 within the next year. So you decide to give them your $1,000 if they promise to pay you back $1,260 in 1 year. So I guess that'd be a 26% rate. The person thinks it over, and they really need the $1,000 now and believe they can easily make the $105 per month payment to get it paid off, so they accept. But here comes good old Uncle Bernie. He says you're not allowed to do that unless you accept unless you accept only $1,150 in a year. Maybe you find these new terms acceptable, maybe you don't. But the real issue is that you and this person had come to a mutually beneficial agreement, which both of you had accepted, and Bernie decided you weren't allowed to do that, maybe to the detriment of the person who is most in need and now may find themselves unable to resolve their financial issues. So, we've got these, I think we can simply say them two opposing viewpoints of, the greed of the Wall Street bankers versus the infinite wisdom of the free market, deciding whether or not we should put a cap on interest rates. And at one level, I'll argue, and I think Nima's going to agree with me here, that both of these articles are right.
Yeah.
But on the other hand, they're both missing the point. A much more important point. So the important point here is that, and I think it can be understood by this last paragraph of...
I think it's neoliberalism.
Yeah,
I think we're done here. No, I'm just kidding.
Understood by the last paragraph of the Think Liberty Network article, where if we look at two people loaning each other money, or one person loaning another person money, where it's like, hey, I got $1,000, Nima could really use it, and I don't really know him that well. I don't know if he's going to pay me back, so I charge him a pretty high rate because I don't know what the chances are of me actually getting paid back. The problem with this comparison is that me loaning Nima money is nothing like a bank loaning somebody money.
Yeah, that's money lending, not banking, to use Minsky's terminology or Randy Ray's terminology.
Right? Because with me, I actually had the money.
Yeah.
But I had to earn it or steal it or borrow it from somebody else myself. And I actually had the money to lend to you. Whereas a bank, like Nima already suggested, they don't have a constraint on how much money they have. When they give a, in quotes, loan, they generate it out of nothing. And as we've discussed in previous episodes, it also has nothing to do with the amount of money that is in the bank. Nima mentioned this earlier when the article mentioned it. It is a popular myth that due to the fractional reserve system, banks have to have a certain amount of money before they can lend it. But in actuality, there's no limit on that lending because they lend first and find reserves later, and the reserves are always available.
Yeah, in actuality, the reserves are created through the lending, actually. So it's the other way around.
Oh, yeah, because then they have to turn around and pull it out of the...
Well, because the reason why for every bank loan, there's a bank deposit, is that when a loan is made, it generates a deposit. It's not that somebody made a deposit and the bank thought, oh, great, I can loan now.
Right.
It's the other way around, yeah.
Right. Now, furthermore, you could say, okay, well, even the bank's ability to do that is like an aspect of the free market, and they have to assess risk, which is true, right? Because even though the bank creates the money out of nothing, and like they extend $1,000 to Nima out of nothing and they charge him interest back, if Nima defaults and doesn't pay that, they still have a loss on their books that they have to account for. So,
right.
So it's not like they can loan out money and be like, they never paid it back, who cares? But the important part is...
Well, it's still not their own money, right? They have a loss on their books, but it's not their own money. It is...
Right. It's not like they earned the money and then lost it.
Right. It's, the example in the Think Liberty article creates a scenario where you basically have equal power distribution among the parties involved. And
Correct.
In the case of a bank and a consumer, you don't have that situation at all. Because the bank has been given a state monopoly on lending, or a state permission on lending that the average person or company doesn't have. In other words, the state has created a system where you need to earn spending points that you have to pay your taxes in our country. Those are called dollars. And you need to earn those to pay your taxes. And for that reason, everyone else needs that money. So the state has created demand for a certain money, and they've given the bank the exclusive permission of creating loans in that currency. And those loans are created out of nowhere. Those spending points are decided or are assigned out of nowhere. They're assigned based on the bank's assessment of the borrower's ability to pay it back. Usually it's supposed to be for business transactions where you have capital improvement of the economy. But over the past decades, for reasons that we've discussed before on our Minsky series and I believe in other shows, consumer loans have become a more prevalent form of lending, which didn't used to be very common. And credit cards are a very common form of such lending. And you can't as an average Joe, you can't just create dollar loans out of nowhere. You have to be a bank, and you have to have the banking privileges to be able to do that.
Yeah, which is worth emphasizing, as we've done before, that the bankers aren't an aspect of the free market. Right. They get to take state power and then play free market rules with it. Right. They are
public-private partnerships. Their deposits are all insured publicly, and their shares are traded privately, and their share ownership, that's obviously private. But they do enjoy a certain degree of state privileges. So this is why I'm saying this is what I mean when I say both of these articles are right. Yes, there are free market rules that these banks play by, and there is such a thing as assessing risk and say, hey, are you going to pay this back or not? However, the progressive article is also right because they're saying, look, people need money. They don't necessarily have access to the money, and these banks are charging them these huge interest rates in order to allow them to have access to money. So we should come up with a way to give people access to money so they're not getting hit with these huge interest rates. And now the article doesn't say this. This is the understanding of MMT, is that people need the government has to give people access to the money somehow because the government is the one demanding the tax. Correct.
Now, we also said that both of these articles are missing the real point. And Nima, would you please enlighten us what the real point is that's being missed?
Well, so banks for centuries, if not even millennia or whatever, how far back we can go, they have always lobbied the state to do austerity policies. And why do they do that? Because austerity reduces the income that the private sector earns through non-debt income. In other words, income that is created through public deficit spending. Because any money earned in the economy that is earned from public deficit spending is not owed back by the private sector actors who earn that money. Meanwhile, any bank that's generated out of bank loans is obviously owed back. And there has to be a healthy balance between those two. In other words, if the public sector runs an insufficient deficit or even runs a balanced budget or surpluses, that means that the private sector will be forced, and I'm using the word forced because it's a state policy, to go to the banks to lend money from the banks. And so the banks happen to have a lot of political power also. We can't ignore that. And institutions, I mean, the U.S. is not so affected by the IMF, but the IMF essentially does policy on behalf of the banks. Everything they do is force states or dictate to states that they need to do austerity, and that benefits the banking sector in the respective countries. So we have a situation where banks are in a inherently privileged position through policy and now get to make loans that are pretty risky loans, such as these consumer loans, and they can charge pretty high rates for those. Now, are those market rates? I don't really know, honestly. We don't really know. I think that would be an interesting point to figure out. The person who wrote the Think Liberty article just assumes that that's the best they can do, and if the rate goes 1 or 2% lower, then that's it. There's going to be less lending. We don't necessarily know if that's the case. We have also seen in the previous article that Ocasio-Cortez plans a postal banking option for lending, which is interesting because it's essentially the government lending, which is what we've been saying here for a long time, that loans used to be made by the state themselves for the longest time, or for certain periods of time in certain countries. And in the US and in the West in general at this point, loans are essentially still made through the government because the Federal Reserve or the central banking system runs it all. But the task of underwriting, etc., is sort of outsourced to the private sector, and the private banks get to compete for some extra, for some profit from the interest. But generally speaking, the public sector could just as well do the lending. Question is, are they as good as underwriting, etc.? Well, the private banks in their privileged position haven't particularly been stellar at underwriting, at least from what we saw in the last crisis. So what would happen if such a public option would be made available that would basically compete with the semi-public option, which is the so-called private banking system? We don't really know, but it would be interesting to find out.
Yeah, and then, there's something you brought up that I think is worth zooming in on a little bit. So even though all money ultimately comes from the federal government, we can kind of split it into two types, which is, okay, there's the private sector net savings, which is money that comes directly from the government. And then there's money that comes from the, in quotes, private banking system, where they loan out money and you have to pay it back. So there's two places for all of us to get money from. And
well, there's also export, current account surpluses would be the third, I guess.
I was trying to make it simple, but yes. in the simplified world here, there's two places to get this money from.
Let's assume no trade,
Let's assume no trade. There's two places to get this money from, and if the federal government shuts its faucet off, where they say, okay, we're not spending any more money into the system, that means there's only one other place to get it from, which is the private banking system. And so I think the progressive side really has a point here where they're saying, look, people need this money, and the only place they have to go right now is the private banking system, and the private banking system is just jacking the prices up. And then, like you said, they're constantly lobbying for austerity. So the private banking system is constantly lobbying for the federal government to turn off their faucet of money. Now everybody has to come run to them, and get money at these high interest rates. And so there's something that's really important for the libertarian side to understand. None of this has anything to do with the free market.
Yeah,
this is all political choices.
The way to from even from a libertarian standpoint, the way to address the indebtedness of the private sector, which, by the way, has been coming down since Trump got into office, which is a good thing. But I don't think it's
we got a long ways to go.
Yeah, I think it's been going fast enough. The private sector is still in much more debt than it would need to be. There's no need to be in this situation. And the cure to that would just be massive tax cuts and not worrying too much about deficits. Because we've lived under austerity for so long, industrial capacity is still underutilized. By the way, we haven't checked in on that number in a while, I believe. But what I thought was interesting is that under the Trump administration, that number has also been going up. So there's some good trends, generally speaking, but there's still a lot of private sector debt, obviously, and the way to address that would just be to be more radical with the tax cuts and not worry so much about deficits and don't do austerity.
Right. And so I think this Loan Shark Prevention Act, while it brings up a good point, it's simply a Band-Aid to the situation. Like you said, Nima, I don't really know what would happen if things got capped at 15% on credit cards. Would this actually, starve a lot of people out for credit that they need? Or would it stop a lot of impulsive people from, buying stuff on consumer loans for, stuff they don't need at prices that they can't afford? I don't know. Although I think I will say that the evidence is there that the lower classes have a tendency to spend without thinking.
Yeah.
One of the reasons that they're lower class is because they don't exactly have the capacity to think several moves ahead. So,
yeah, they've been deprived of that because of the public schooling system, which is shit.
Absolutely.
But by the way, I just wanted to mention here the number that I was just... So industry capacity utilization in November of 2016 was 74%. It's now gone as high as 79, almost 80% in November 2018.
So moving up, but still a long ways to go.
Still a long ways to go, yeah.
Another thing I wanted to bring up was slavery. Weren't you thinking about slavery, Nima?
Well, I mean, back in the days, if you couldn't pay your debt, you would just be sold into slavery, right?
Exactly. That's exactly what I wanted to bring up.
You would just be in slavery, basically.
Yeah, and your families could be sold into slavery. Like, you got to start selling your children and your wives and whatever.
Yeah, you just have your wasn't there some mention in Graeber's book Debt where he talks about how in Ireland, if a girl wanted to marry, she would have to go in debt, and then right after the wedding, she would be shipped off to the creditor, had to spend a year or so as a concubine, and then was finally allowed to move on with her life.
I don't remember that specific part, but that does sound very familiar because the whole book was filled with crap like that.
Yeah.
Another part I was thinking about from that book was the Jubilees from ancient Sumeria. So it was a regular problem in ancient Sumeria, actually, when loaning money was first figured out, and there was lenders, money lending in the sense of we actually have the cash and we're going to lend it to you. I mean, I think maybe they made it up. Who knows? But if you had a peasant who needed a little bit of help to get his farm going and he borrowed something at a very high rate, one bad year could just destroy you. And if the answer to not being able to pay your debts is to be sold into slavery and have your entire family sold into slavery, a bad year for farming could wipe out all the peasantry and enslave them all. And not only is that a problem for the peasantry, well, you just took all the people who were working the land and turned them into house slaves or whatever, right? And I guess this was such a reoccurring problem in ancient Sumeria that it was just a regular thing for the ruler to declare a jubilee or a clean slate on all consumer loans.
Yeah. Well, and the book Debt by David Graeber, it's filled with examples of people in positions of power, partly state-sanctioned, doing whatever they can to put other people in debt to them and creating this numerical relationship between the two of them. And today we tend to just assume that these debts are natural, that it's all
free market,
part of the free market, etc. But it's much less so than you might think. And I think that's an important thing that I took away from reading that book.
And it's the kind of the moral of the story that we're trying to get across here. Because what Nima was just saying a few minutes ago, where the banking system is always lobbying the governments into austerity, well, I mean, who knows who was lobbying who in ancient Sumeria? But if we look at what we just saw, where these peasants need access to money and they're going to go into debt, and then all of a sudden, oh hey, we have a bad year and now we're all sold into slavery. Well, why did they have to go into debt in the first place?
Yeah, because of the lack of non-debt income.
The lack of non-debt income. Yeah. Now, I mean, who knows if the Sumerian kings back in the day understood the economics of the situation to do this on purpose. I'm guessing they didn't. Otherwise, they wouldn't have been declaring jubilees on a regular basis.
Yeah, but what they've also done is when they wanted to go to war, for example, the first ever recorded story of compound interest was one where one Sumerian king calculated that some other neighboring king had been occupying his land, and he calculated the amount of grain that he lost out on with compound interest, added up to something like several trillion pounds of grain, something that he could have never paid. So then he went to war with him. So debt can just be a pretext to war, or it can just be a power tool to use to subjugate other people.
Well, and then this isn't what the article was about, but Bernie Sanders is ranting about it all the time, which is the student debt. And the student debt that we have in this country is very similar to being sold into slavery, because first of all, you can't get rid of it, right? It's really this modern, amazing phenomenon that we have this thing called bankruptcy, where you can clear your debts. I mean, yeah, it hurts your credit, but you don't get sold into slavery, or go to jail.
Well, it's not even that modern. It's comparable to the Jubilee that you just
very good point. Thank you very much. However, with student debt, you can't get rid of it, and I'm even starting to read stuff where you can't get a driver's license if you've been late on your student loans, and at least in the United States, unless you're living in the center of a big city, if you can't get a driver's license, you can't do anything.
Yeah.
So, I mean, who's going to hire you if you can't get a driver's license? So, this is also comparable to alimony and child support, two other debts that you can't bankrupt yourself out of and that you can go to jail for and get your things like your driver's license removed or your wages garnished and stuff like this. However, with though, or at least with the child support, there's some sort of vague argument that you can make that's okay, because this child's dependent on you. But with the student loans, we've entirely set people up to bring them through this public educational system. They get 15,000 hours shoved down their throats, saying you need to go to college to be successful in life. They throw them through college. They give them these bullshit degrees. They end up $100,000 in debt, which if you take the interest at 8 or 9% over 30 years, it's actually more like $250,000 in debt. And then say, okay, if you don't pay it back, you can't work. Because we won't let you get a driver's license. That's pretty damn close to getting sold into slavery.
Yeah, I guess it makes sense that the people who build schools are the same people who build prisons.
Yep. Absolutely. So.
And one more point I would point out is that, well, one thing we could do immediately to lower the interest rate would be to drop the Fed funds rate to 0, because that's just a subsidy to people with money, and we're against government subsidies. And at the same time, it would lower everyone's interest rate by something like 3%, maybe. So that's just another thing that could be done that, nobody's going to advocate in the mainstream because the general dogma is against that.
Yep. And you know what's so frustrating that I find? When it comes to MMT and the things that we're talking about, the neoclassical team and the Austrian team seem to be on the same side to me.
Yeah, but that's because the Austrian school is an offshoot of neoclassical economics, right?
But
they're not.
But I mean, when they look at each other, they're at each other's throats. But when I look at it from an MMT side, they attack the MMT people for the same reasons.
Yes, exactly. Yeah, their common denominator is all the falsehoods that we try to debunk here every week.
So, and then I guess the solution, which is the same solution we've been saying all the time, is we need to increase the deficit from the federal government, and our preferred way is to cut the taxes. Cut the damn taxes, and our opinion is to start with the self-employment / FICA taxes.
Yeah.
Just get rid of them. They do nothing.
Yeah. And the income taxes are also unneeded. And maybe you have a job guarantee program, but that's something where, I would say let's just try to slash the taxes and then see if we need a job guarantee program. We may need one for residual occurrences.
I also think for regional occurrences, because we have this tendency to talk about the economy as it's like one homogenous bucket where everything is just immediately mixed in with everything else. But I think there's different regions that do a lot better than other regions, and to give all regions an equal access to this federal transition job, where the lower end of unemployment can be caught in a net and not fall off a cliff. I think it would be very, very beneficial to rural areas that don't necessarily have a lot of money being dumped on them otherwise.
Yeah, no doubt.
Got it?
So,
yeah, you got anything else, Nima? I think we covered it.
Yeah, I think we covered everything we had to say about private loans and the 15% cap proposal. I'm not necessarily against it or for it, but I think there's some bigger points that both sides should be looking at.
Right. It's kind of a Band-Aid on a bigger problem. If it even works, we don't even know.
Exactly. And with that, this has been Amagi, hosted by myself, Nima of economicsjunkie.com, and Dylan Moore of the Volitional Science Network. And we are graciously being hosted by the Think Liberty Network, which you can find at think-liberty.com. This has been episode 33. Thank you very much for listening, and we will see you next time.